this is Paul Explains, the channel where a middle-aged, balding, bearded, slightly chubby guy is simplifying financial products and services for you guys at home. So today we're going to start with life insurance. Now, some people know all about life insurance. You may have it, you may not. I'm just going to break down the different types as simply as I possibly can. So first of all, why do people have life insurance? Well, generally it's to pay off a debt. So a debt can be loans, cards, but most importantly, and the reason we're talking about this, is your mortgage. So if you have a mortgage, it might be 150,000 over 20 years on a repayment basis, you're going to want to make sure that if something happens to you within that time, that your mortgage is paid off. So we look at what's called a decreasing policy. Okay, so a decreasing policy does exactly as it says and decreases over time. Now, you would take out that policy at 150,000 over 20 years, and if you were to die at any time during that term, it would pay out the remaining balance of the mortgage to your estate, which means that there's no debt left over for the family or your partner after that. Okay, now that's a repayment mortgage. Should you have an interest-only mortgage, it would decrease over time. So in that case, we'd have what's called a level term policy. So once again, if your mortgage is 150,000 over 20 years, we would have a level policy, 150,000 over 20 years. Just write level there so we don't forget. Okay, and at any point during that 20 years, you pass on, it pays out 150,000 to your estate, which once again can clear your mortgage. Okay, so who should have life insurance? So, okay, if you've got a mortgage, yeah, you probably want to get the mortgage paid off if you die, save your family some hassle. But more importantly, if you've got a partner or you have children, then it's essential that the mortgage is paid off if you pass on, because you don't want to pass on that debt. How would the family pay for the mortgage after you've passed on? It might be that they could do that comfortably, but in most cases, they wouldn't be able to. Okay, so decreasing policy, level term policy, depending on whether you've got a repayment or an interest-only mortgage. So that's our mortgage taken care of if we die. But a lot of people like to go one step further. Okay, so what we could have is our mortgage covered, and also another level term policy, I don't know, that runs until the children are 21, let's say, if you've got children. And at any point, that pays off your mortgage and a sum of money to the remaining family to help them just adjust to the loss of a person and an income. So with life insurance, you have what's called a Summershort. Okay, so that's your 150. You pick that amount. If it's a mortgage, it's based upon the mortgage. If it's to protect your family, it's whatever amount you think is comfortable. And you also have a term. So once again, you pick the term. If it's mortgage, it would be the mortgage term. If it's to protect your family, it might be until the child is 21, until your retirement at 68 or whatever it may be. Or you can run a policy all the way up to 90 years old with certain providers. And that just means that at any time you pass on, there's some money paid out to your estate. Now, of course, we'll talk about this another time, you have to watch out for inheritance tax as well. So too much of this means that you could have an inheritance tax bill when you pass on, but we'll talk about that another time. Okay, so with any life insurance policy, or the majority of life insurance policy, you will also have something called terminal illness. Now, as an advisor, this is one of the biggest bugbears. It's a great benefit, but people often think when they're taking out a policy that they have critical illness. Critical illness pays out if you have a specified illness. Terminal illness pays out on your policy if you've given 12 months or less to live by a doctor. So if the doctor says you've got 12 months or less to live, I know that's a bit grim, but if that were to happen, your policy would pay out in full before you actually die. And that's just to give you the ability to get your affairs in order before you pass on. A horrible thing to talk about, but quite a useful feature. The downside of that, as I say, people often think that they've got critical illness and they haven't. It's just terminal illness. Now, I said that it's if you're given 12 months or less to live. Some older providers have slightly different wording in the policy document, so just worth checking on that. But usually, most providers, 12 months or less to live, terminal illness. Now, sometimes I get asked the question as well, with life insurance, how do I need to die to get a payout? And with life insurance, it covers you for absolutely everything, unless you die during some criminal activity, let's say, or you kill yourself within the first year. Once again, horrible to talk about, but life insurance covers every type of illness, every type of accident. Basically, if you die within the term of the policy, it's going to pay out the sum that you've insured yourself for. The best thing about life insurance, it's dirt cheap, particularly if you do it while you're a bit younger. So you'll kind of get the gist that during my videos, I'm trying to get younger people thinking about financial services earlier. If you do life insurance in your 20s, it literally costs peanuts. Once you get to your 30s, 40s, 50s, it becomes more and more expensive. So the reason I'm mentioning that is because when you take out life insurance, there's a couple of options, but the majority of the time you would go for what's called a guaranteed premium. And a guaranteed premium means that if you take out a policy at 21 and it costs £6 a month, it will cost £6 a month throughout the duration of the policy. Just be careful if you've got life insurance or you're taking it out that you don't do what's called a reviewable policy. Not that they're terrible, but what a reviewable policy means is that the provider can review the policy periodically, and that means that your premium could go up. It could also go down, but more often than not it's going to go up. So guaranteed premium is always a sensible option. It means what you pay day one, you'll pay through the duration of the policy. Now, different providers have different payout rates. Some of the bigger providers, Aviva, Legal and General, ARG, their payout rates are really, really high. Some of the other providers slightly lower, but worth looking at an individual provider's payout rates and their statistics easily found online. Different providers offer different additional products with the life insurance as well. That's something we'll talk about in another video because it's quite lengthy. In short, your main types of life insurance are decreasing term policy to cover your mortgage or a debt, and level term policy, which is used to cover an interest-only mortgage or to leave some extra money to your family. One other thing that I'd like to talk about is called whole of life. Okay, so a whole of life policy is also an insurance contract. However, it guarantees to pay out no matter when you die. Unlike these policies that have a term attached, whole of life pays out no matter when you die. The downside of that is because it's guaranteed to pay out, it costs significantly more money than these type of policies. Once again, if you do it while you're young, premium is much, much lower. Whole of life policy would generally be used to cover an inheritance tax bill. Once again, inheritance tax bill video a bit more complicated. And also potentially to be used to pay for funeral costs. Now, you might think that if you've got a policy here that runs until 80, you don't need this. If you live to be 90, perhaps you do need this. Now, there's also funeral plans available as well, which are also to pay for funeral costs, but they cover a service as opposed to this paying out cash to your family and your estate again. We'll do another video on whole of life at some point, but in short, they're the types of cover. Decreasing, level, and whole of life. That's basically life insurance in a nutshell. The reality is that if you've got a mortgage, if you've got a partner, if you've got children, or somebody that would be disadvantaged financially by your death, then you need some of these products. Once again, any further questions, pop them in the comments or send me an email, and I'll obviously be happy to get back to you and show you where you can get these products and who is the best to go for your particular circumstances. Please, as usual, like, share, subscribe. I'm trying to share this knowledge, grow this channel. Once again, love to get you guys involved. So if you've got any questions or stories or queries, please put them in the comments. And I'll catch you in the next video, which is going to be critical illness. Really important one, a bit more complicated. But this is Paul Explains, and bye-bye for now.